Hello and welcome to the Assay TV. Today I'm very happy to be joined by Angelos Damaskos, Chief Executive Officer at Sector Investment Manager. So Angelos, thanks for joining us here today at the One-to-One Mining Investment London event.
Thank you, Amy. Good to be back. It's an established fixture in our calendar, so very pleased to be here.
Always a pleasure to have you back. And so, we're going to take a quick look at precious metals investment. So, how is the current macroeconomic environment influencing investment into this sector right now?
Well, the macroeconomic environment has been constructive for precious metals and safe haven assets for a while. But gold has frustrated us all for several years, as you know, with this sort of ceiling of price level of around $2,000 per ounce that positioned investors sort of defensively compared to mining companies and safe havens. And it seems that, in my view, what was the game changer this year was the Trump administration coming in and upending the status of the U.S. as a regional power, as the favored ally of the world, as a constructive partner for most of the developed world. So with the impact of what's happening between Russia and Ukraine, the geopolitics of the Middle East, I think there was a transformative event for investors who realized that they probably need safe haven assets much more than they thought before. So in addition to the central banks that have been buying into gold and silver, for that matter, for several years now, in order to diversify the reserves away from the US dollar, we had this massive new influx of generalist investors and funds who are looking to increase their safe haven allocations.
I mean, do you see that safe haven investment as the key driver for investing into gold? What sort of role do you see in an overall investment portfolio across the precious metals?
Most definitely the safe haven asset is a driver because the debt levels around the world have been the major concern of ours for a while. You see the US sitting at 124% of debt to GDP, the European continent around 95, 100% debt to GDP. Even China is at 84% debt to GDP. So the world is incredibly indebted at the state level as well as the private level. And this is not going to go away easily. People and politicians, and particularly the central banks, hope that they will inflate it away as the inflation stays relatively higher, plus the growth in the economy, if they manage to stimulate growth, could erode the value of that debt. But as long as inflation, in my view, stays at the current levels, vis-a-vis a world economic growth which is very nascent and fairly weak compared to historical patterns, there are very few solutions for debt to GDP rather than printing more money. And that's where the safe haven assets come into play for any portfolio to protect value.
I mean, yeah, that makes sense. I mean, you spoke earlier about kind of the central bank buying for precious metals as also being kind of a key driver for the high prices that we've seen recently. So, what sort of impact do you see of that central bank buying? Do you see that kind of continuing moving forward?
Well, we all know that central banks are not speculators. They take a policy decision, and once they take a policy decision, they keep buying into the market consistently, month after month. They are not trying to buy on the dips. They are not trying to stop their buying if they see the price rising significantly. It's a policy decision to diversify the reserves. And they have been following at least the central banks of the developing countries, particularly China, India, Turkey, some of these growing economies. Russia, for example, bought massive amounts of gold since the Crimean invasion in 2014 because they were placed under sanctions and they thought they had to diversify away from the US dollar. So central banks are not stopping their buying. What is the new game changer is the financial investor stepping in and seeking to increase the allocation in the portfolios in safe havens, particularly gold.
I mean, in addition to kind of investing in the physical, there's been also this kind of surge in investing in ETFs recently in the precious metal space. So, how do you kind of assess where to allocate and the advantages of either option.
Well, there are ETFs and ETFs. There are ETFs that are backed by bullion, and these are the more solid ETFs as far as I'm concerned. And there are others that are pure paper trades. And the surge in popularity of ETFs is precisely because the financial investors, the middle size or smaller size financial investor, doesn't have the capacity to buy gold bullion physical and store it in a location in their name. They have to buy in smaller contracts through ETFs. So there, the choice is between those ETFs that are backed by bullion, which is stored somewhere physically, and others who are just paper trades. So we always favor the ETFs that are backed by bullion because it's a safer bet.
That makes sense. And so let's shift over to look at silver. So silver's had quite a bit of interest over the past year or two, and it does have this kind of dual role. So, how does that duality impact investor interest, pricing, and kind of appeal for silver?
Well, silver is a cousin to gold in terms of safe haven appeal, but it has a very important industrial demand and applications to many high technology, electrification, etc., solar panels, photovoltaics. So there is a significant industrial demand for silver, unlike gold, which is an asset that is kept in storage as a safe haven asset. So that is a particularly important distinction between the two. However, silver does have a very strong appeal to safe haven investors as a safe haven asset due to its sort of longevity and sort of historical relationship to gold. And funnily enough, it is a much narrower market, less well understood, and it's much more volatile than gold, both on the upside as well as on the downside. But it has this tendency, in my experience at least over 20 years, to lag the performance of gold by a significant margin, sometimes 6 months, sometimes 1 year, sometimes longer. So as far as this year is concerned, the silver price action was probably the best advertised event that an investor could have. We have seen gold rise consistently through the year, pretty much in a very even trajectory, and silver lagged for the first few months of the year, and suddenly it caught up. So it was a fairly clear event to anticipate, so to speak, as an investor and position ahead of a potential move.
Interesting. And so, you've spoken about some of the kind of opportunities there. What are some of the biggest risks, when investing into precious metals?
Well, it's the risk is that the situation with the debt level somehow gets resolved around the world, and geopolitics calm down. There is peace between Russia and Ukraine. There is stability in the Middle East. These are the things that shape our world these years, and I frankly don't see any easy resolution to these events. And that is the risk one would take, that if all of these things get resolved and the world becomes a much happier place, there is less need for safe havens. And therefore, people sell gold or, diversify out of gold into equities or other risk-on investments to benefit from stability and economic growth, and therefore the gold price falls.
We don't really see that situation happening.
I don't see it happening anytime soon, and that's the reason for holding a significant proportion of one's portfolio into gold to insulate against the potential volatility. Let's not forget that there are many pockets of the market that at the moment are in a kind of bubble territory. At least as far as I'm concerned, I see the AI sort of fashion and all this interest in AI, anything AI related, to be a very clear bubble. There will be winners out of this bubble, and there will be many, many losers. Companies are investing trillions of dollars into AI. Obviously, it's a transformative technology. It could result into significant economic benefits for the world, but it's going to take many years. And even the biggest tech groups cannot see clearly how AI is going to be applied in practice. It's just a wild bet at the moment and a massive investment into something that is entirely unknown.
Absolutely. I mean, you talked about kind of diversifying away if we were in this kind of perfect world situation where we didn't need that safe haven. And part of that diversification strategy that people have been talking about is looking at things like digital assets and Bitcoin. So do you see kind of a risk for the precious metals from these digital assets?
Not at all. I think the digital asset move is entirely uncorrelated to precious metals. It is not a safe haven move. It is simply a lack of trust in government and central banking and the monetary value of our fiat system. And it's a technology way to address it, but I see that as a massive bubble as well, particularly for the digital assets that are not backed by anything physical. And we know there are many so-called stable coins that are either backed by US dollars or by gold or by other physical assets. These are the more stable sort of digital currencies that one would feel that they have more security behind it. But even there, you see a massive gap in the valuation of the actual traded instrument, which is the token, and the underlying value of the physical backing. So there are questions, what would encourage me to invest in something where it is priced well above asset value? And there are run the risk that this premium to asset value could contract at some point if the sentiment changes.
Absolutely. And so, just to wrap it up, what's your outlook for precious metals, for gold pricing through 2026? So, we mentioned in the opening panel today that some analysts are predicting a $5,000 gold. What's your take?
I think we will most likely see $5,000 per ounce next year. And it all depends on the geopolitics and macroeconomic condition of the world. But we probably are going to consolidate around 4,000 for a while. It's also related to the stability of the global equity markets. I'm particularly concerned about the stability of the global equity markets as a result of this over hype of technology and AI and everything related to it, which doesn't translate necessarily to the global economic health. So if we have volatility in the equity markets, downwards, I mean, there is a scramble for liquidity, and we may even see pressure on gold as some actors need to shore up liquidity in whatever they have. And this has happened many times before. But I think the 3,800 level is a very solid support. And once we consolidate and navigate any turbulence in the global markets, we should see a further strength in the precious metals and safe havens.
Excellent. We'll definitely have to keep our eye out for that in 2026. So, Angelos, I want to thank you for joining us here today at 1 to 1 London and on the Assay.
Thank you. Thank you for hosting.
Thanks.